Before we begin, a quick and important disclaimer. The content of this video is for educational and entertainment purposes only and does not constitute professional legal, financial, or tax advice. Divorce laws and retirement account regulations, particularly those involving the Employee Retirement Income Security Act (ERISA), are highly complex and vary significantly by state and individual circumstance. You should not rely on this information to make decisions regarding your own assets. Always conduct your own due diligence and consult with a qualified family law attorney and a certified financial planner before taking any action. You have spent 25 years building a life, a family, and a retirement nest egg. You have diligently maximized your 401k contributions, weathered market crashes, and watched your compound interest transform from a modest sum into a mid-six-figure or even seven-figure sanctuary for your future. Then the unthinkable happens. The marriage ends. Within months, a document you have never heard of, a qualified domestic relations order, or QDRO lands on a judge's desk, and with a single signature, half of your life's work vanishes from your dashboard. It is not being stolen, it is being legally reallocated. In contemporary American culture, the 401k is often the single largest marital asset, sometimes even eclipsing the equity in the family home. Yet, most people enter the divorce process with a fundamental misunderstanding of how these accounts are treated under federal law. We are currently witnessing a massive shift in how wealth is dismantled during a split, and if you do not understand the mechanics of the 401k divorce, you are essentially flying a plane through a storm without a radar. This video is your comprehensive masterclass on the 401k divorce in the modern era. By the time we finish this deep dive, you will understand the precise legal mechanisms that govern retirement division, the hidden tax traps that can liquidate 20% of your value overnight, and the strategic shifts occurring in U.S. family courts today. This is the information that high-net-worth individuals pay thousands in billable hours to hear, and we are laying it all out to ensure you have the clarity needed to navigate one of the most stressful financial transitions a person can face. To understand why the 401k is such a flashpoint in modern divorce, we have to look at the historical trend of American retirement. A generation ago, the primary vehicle for retirement was the pension. Pensions were defined benefit plans, meaning the employer promised a specific monthly check for life. Dividing a pension was relatively straightforward. You calculated the years of service during the marriage and divided the future monthly check. Today, we live in the era of the defined contribution plan. The 401k is a live, fluctuating bucket of cash and securities. It is volatile, it is immediate, and because it represents real money that can be seen on a smartphone app every morning, it has become the most contested territory in the American legal system. When a couple decides to part ways, the 401k is not viewed by the court as his or hers, regardless of whose name is on the account. In the eyes of the law, retirement contributions made during the marriage are considered marital property. This brings us to the first pillar of our deep dive, the distinction between separate and marital property. Imagine you started your career 3 years before you got married. At the time of your wedding, you had $50,000 in your 401k. 10 years later, at the time of your divorce, that account is worth $500,000. In most U.S. jurisdictions, that initial $50,000, plus the market growth specifically attributed to that $50,000, might be considered separate property. However, the $450,000 added through contributions and growth during the marriage is marital property. The complexity arises when you try to trace that growth. Without meticulous record-keeping, courts often default to a commingling theory, where separate assets become so intertwined with marital assets that the whole account is treated as one pot to be split. This leads us to the most critical legal instrument in this entire process, the Qualified Domestic Relations Order, or QDRO. You cannot simply log into your Fidelity or Vanguard account and wire half the money to your ex-spouse. If you do that, the IRS will treat it as an early withdrawal. You will be hit with immediate income tax on the full amount, plus a 10% early withdrawal penalty if you are under the age of 59 and a half. A QDRO is a specialized court order that instructs the 401k plan administrator to carve out a portion of the account for an alternate payee, typically the ex-spouse, without triggering those immediate taxes or penalties. The QDRO is the golden key of 401k division, but it is also where many people make catastrophic errors. There is a specific window of time between the divorce decree and the finalization of the QDRO. If the account owner retires, dies, or moves the money before that QDRO is officially qualified by the plan administrator, the non-employee spouse could lose their claim to the funds entirely. We have seen case studies where individuals lost hundreds of thousands of dollars because their attorney failed to follow through on the administrative approval of the QDRO after the divorce was finalized. In contemporary American culture, we are also seeing a rise in gray divorce. Couples over the age of 50 splitting after decades of marriage. For this demographic, the 401k isn't just a number. It is the only thing standing between a comfortable retirement and having to re-enter the workforce in their 70s. This has led to a strategic shift in how these assets are negotiated. Instead of a 50-50 split of every individual account, many couples are now engaging in asset offsetting. For example, one spouse might keep the $600,000 family home, while the other spouse keeps the $600,000 401k. On paper, this looks equal. In reality, it is rarely equal. The house is bought with post-tax dollars, but the 401k is a tax-deferred liability. When the person with the 401k eventually goes to spend that $600,000, they will have to pay federal and state income taxes on every penny. The person with the house, thanks to current U.S. tax code, might sell that home and keep up to $250,000, or $500,000 if still married at the time of sale, in capital gains tax-free. This tax-adjusted valuation is the difference between a fair settlement and a financial disaster. Furthermore, we must address the psychological impact of 401k division. In many American households, the 401k represents more than just money. It represents security, autonomy, and the American dream. Seeing that balance drop by half can trigger a scarcity mindset that leads to prolonged, expensive litigation. People will spend $50,000 in legal fees to fight over $40,000 in a 401k, simply out of a sense of betrayal or fear. As we move forward in this series, we are going to break down the specific math of these splits. We will look at how to handle outstanding 401k loans, which can become due in full immediately upon a job change or divorce, and how to navigate the Section 72T exception, which actually allows a divorcing spouse to access cash from a 401k via a QDRO without the 10% penalty, a rare silver lining in the tax code that most people overlook. The 401k divorce is not just a legal procedure. It is a total restructuring of your future. Whether you are the participant, the one who earned the money, or the alternate payee, the one receiving a portion, understanding the nuances of ERISA law, tax liabilities, and state-specific equitable distribution rules is the only way to ensure that your new beginning isn't a financial ending. We are going to peel back the layers on why the system is designed the way it is, and more importantly, how you can protect your interests in a landscape where the rules are constantly evolving. This is part 1 of our 10-part deep dive. Prepare yourself because the details matter now more than ever. To understand the sheer magnitude of what is at stake, let us look at a scenario involving a couple we will call Michael and Sarah, living in a high-cost suburb of Chicago in early 2026. Michael has been a senior software architect for 15 years, and his 401k is sitting at $850,000. Sarah has worked part-time while raising their 2 children and has a smaller retirement account worth $40,000. In the heat of a divorce filing, Michael might assume that because his name is the only one on the $850,000 account, it belongs to him. However, under the laws of most states, the vast majority of that balance is considered a marital asset. If they married in 2011 and he started the job in 2011, the entire balance is on the table. In contemporary American culture, the 401k has become the primary battleground because it is often the only liquid adjacent asset large enough to facilitate a clean break. The first step in the actual mechanics of the 401k divorce is the discovery phase. This is where many people lose the game before it even starts. In 2026, discovery is no longer just about looking at a quarterly PDF statement. It involves a forensic look at contribution histories, loan balances, and employer matching structures. Imagine if Michael had taken out a $50,000 401k loan 2 years ago to renovate the kitchen. That loan is technically a debt to himself, but in a divorce it is a marital liability. If the court orders a 50-50 split of the $850,000, does Sarah get half of the gross amount, or half of the amount net of the loan? If the QDRO is drafted poorly, Michael could end up responsible for the entire debt, while Sarah walks away with half of the total value. This is why line item scrutiny of the summary plan description is mandatory. Every 401k plan has its own unique rulebook, and ignoring it is like playing chess without knowing how the knight moves. Let us dive deeper into the specific math of the marital portion. In American family law, there is a concept known as the coverture fraction or the Majoska's formula, often used for pensions but adapted for defined contribution plans. This is a mathematical ratio used to determine exactly how much of a retirement account was earned during the marriage versus before or after. For example, if a worker was at a company for 20 years but only married for 10 of those years, the coverture fraction might suggest that 50% of the value is marital and the other 50% is separate property. However, in 2026, market volatility makes this simple division dangerous. If the 401k grew by 20% in the last 2 years due to a bull market in tech stocks, and those were years of marriage, the non-employee spouse's attorney will argue for a larger slice of those specific gains. Case studies show that couples who do not hire a financial neutral to perform these calculations often end up in a stalemate that costs more in legal fees than the disputed amount is actually worth. Now, we have to talk about the hidden tax trap of the 401k division. This is the single biggest mistake made in modern American divorces. Most people view $500,000 in a 401k as being equal to $500,000 in a savings account. It is not. In fact, it is not even close. The 401k is a tax-deferred vehicle, meaning every dollar in that account is burdened by a future tax bill at ordinary income rates. If Sarah receives $400,000 from Michael's 401k via QDRO, and she immediately rolls it over into her own IRA, she preserves the tax-deferred status. But if she decides she needs $100,000 of that cash right now to put a down payment on a new condo, she is hit with a massive tax bill. Historically, many people forget that the 401k is essentially a joint venture with the IRS. When you divide the account, you are also dividing a future tax liability. If one spouse takes the house and the other takes the 401k, the spouse with the 401k is effectively taking a 20 to 30% haircut on the value of their share because of those future taxes. Step by step, the process moves from the discovery phase to the valuation phase, and then to the drafting phase. The drafting of the QDRO is where the technical precision becomes a matter of survival. A standard divorce decree is not enough. You can have a signed piece of paper from a judge saying Sarah is entitled to 50% of the account. But if the plan administrator of Michael's company looks at the QDRO and finds a single typo or an instruction that contradicts company policy, they will reject it. This can lead to a legal limbo where the divorce is final but the money is stuck. In 2026, many major U.S. corporations have outsourced their 401k management to third-party administrators who use automated systems to vet QDROs. If your document does not match their specific template, it is discarded. This is why specialized QDRO attorneys exist. They do not litigate the divorce. They simply speak the language of the plan administrator. Consider the case study of a mid-level manager at a logistics firm in Ohio. He had a 401k valued at $300,000. During the divorce, he and his spouse agreed to split it equally. However, between the time they agreed on the $150,000 split and the time the QDRO was actually processed 4 months later, the market took a sharp downturn. The account dropped to $240,000. Because the QDRO was written for a fixed dollar amount of $150,000 rather than a percentage of the account, the husband was left with only $90,000, while the wife still received her full $150,000. He bore 100% of the market loss. In contemporary American culture, where market swings of 10% in a week are not uncommon, failing to specify whether the award is a fixed sum or a percentage, and whether it includes gains and losses from a specific valuation date, is a recipe for financial ruin. Furthermore, we must examine the 10% penalty exception, which is one of the few strategic advantages available during a divorce. Under Internal Revenue Code Section 72(t)(2)(c), payments made to an alternate payee under a QDRO are not subject to the 10% early withdrawal penalty, even if the person is under age 59 and a half. This is a powerful tool for the spouse receiving the money. If Sarah needs liquidity to restart her life, she can take a cash distribution directly from the 401k as part of the QDRO process. She will still owe income tax on it, but she avoids that 10% penalty that usually applies to early withdrawals. However, this only works if the money comes directly from the 401k. If she rolls the money into an IRA first and then tries to withdraw it, the 10% penalty applies. This is the kind of granular detail that separates a successful transition from a decade of playing catch-up. As we continue to navigate the complexities of the 401k divorce, we have to look at what happens when the 401k is not the only retirement asset. In the modern American workforce, many people have multiple 401ks from previous employers, 403bs from nonprofit work, and perhaps a Roth IRA on the side. Each of these requires a different legal strategy. The Roth IRA, for instance, is funded with post-tax dollars, making it far more valuable dollar for dollar than a traditional 401k. If you are trading $50,000 of a Roth for $50,000 of a 401k, you are making a massive mistake. The divide is not just about the money today, it is about the projected growth of that money over the next 20 years. If you are 40 years old, that $100,000 you are fighting over today could be worth $400,000 by the time you retire. The decisions made in the courtroom in 2026 are not just impacting your current bank balance, they are dictating the quality of your life in 2046. But what happens when the account owner tries to hide the money? Or what if the employer match has not yet vested? These are the high-stakes questions that lead us into the darker corners of asset division. In the next part, we are going to look at the aggressive tactics used to shield retirement assets and the forensic tools used to find them. We will also explore the nightmare scenario. What happens to the 401k split if one spouse files for bankruptcy in the middle of the divorce? The intersection of bankruptcy law and family law is a minefield, and you need to know where the tripwires are buried before you take another step. Imagine if you are sitting in a mahogany row office in downtown Charlotte, North Carolina. It is June 2026, and your attorney just dropped a bombshell. Your spouse has filed for Chapter 7 bankruptcy while your divorce is still pending. Most people assume that bankruptcy is a complete shield, a financial reset button that freezes everything in its tracks. While the automatic stay in bankruptcy does halt most collection efforts, it creates a chaotic overlap when a 401k is involved. In the United States, 401k assets are generally protected from creditors under ERISA law, but the right of a spouse to receive a portion of that 401k via a QDRO is a distinct legal claim. If the bankruptcy happens before the QDRO is finalized, you could find yourself in a federal court fighting for your share of the retirement pie while creditors circle the rest of the marital estate. This brings us to the high-stakes world of asset shielding and the forensic tools used to expose it. In contemporary American culture, the 401k is often seen as a static vault, but for those looking to minimize their spouse's share, it can become a tool for strategic depletion. A common tactic seen in historical trends involves the sudden, unexplained increase in 401k loans just months before a divorce filing. Let us look at the case study of James, a project manager at a major aerospace firm. Sensing the marriage was ending in late 2025, James took the maximum allowable loan from his 401k, $50,000, and used it to pay down a personal credit card debt that his spouse, Linda, was unaware of. By the time they reached the valuation phase in 2026, the 401k balance appeared $50,000 lower. Without a forensic accountant to trace the flow of funds and argue that this was a dissipation of marital assets, Linda would have effectively subsidized James's private debt repayment out of her future retirement security. Forensic accounting in 2026 has evolved. It is no longer just about looking for hidden bank accounts in the Cayman Islands. It is about analyzing the vesting schedule of employer contributions. This is a critical nuance that most people miss. Imagine you have $200,000 in your 401k, but your employer's matching contributions follow a 5-year graded vesting schedule. If you have only been at the company for 3 years, a significant portion of that $200,000 is unvested. It is phantom money that could vanish if you leave the job tomorrow. In a divorce, how do you value that? If a judge awards the non-employee spouse 50% of the total balance, including unvested funds, but the employee spouse gets laid off 6 months later, the employee is left holding a massive debt they cannot pay. The solution often involves if, as, and when orders which specify that the non-employee spouse only receives their share of the matching funds once they actually vest. This requires a level of administrative tracking that can span years after the divorce is finalized. Then there is the issue of the hidden 401k. In the gig economy and the era of frequent job hopping, many Americans have orphan 401k accounts sitting with former employers from 5 or 10 years ago. These accounts are easily forgotten, sometimes intentionally. During the discovery phase, it is vital to review Social Security Administration earnings records or use a service that tracks down lost retirement accounts. We have seen case studies where a spouse forgot a $120,000 account from a job they held in their 20s. 10 years of market growth turned that forgotten account into a major asset. In 2026, failing to disclose these accounts can lead to a charge of perjury or a court-ordered redistribution of assets years after the divorce decree was signed. Transparency is not just a moral choice. It is a defensive necessity. Step by step, let us look at how you handle the valuation date conflict, which is where the most aggressive legal maneuvering occurs. In a volatile market, the difference between valuing a 401k on the date of separation versus the date of the final trial can be tens of thousands of dollars. Imagine a scenario in 2026 where the S&P 500 drops 15% in the 3 months it takes to get a court date. If the spouse keeping the 401k is forced to pay out a sum based on the higher separation date value, they are effectively paying out more than half of the current value of the account. Conversely, if the market booms, the spouse receiving the money will fight for the trial date valuation to capture those gains. This is why many savvy negotiators now insist on a fluctuation clause in their settlement agreements. This clause ensures that the amount to be transferred via QDRO is adjusted for market gains or losses up until the day of the transfer. Without this, you are gambling on the timing of the court's calendar. Another emerging trend in contemporary American culture is the treatment of catch-up contributions. For those over age 50, federal law allows for additional contributions to 401k accounts. In a divorce, these catch-up contributions are often the focus of intense scrutiny. Are they being used to legitimately build a retirement nest egg? Or are they being used to hide income that would otherwise be subject to child support or alimony calculations? Since 401k contributions reduce your adjusted gross income, a spouse might aggressively max out their contributions to make themselves look poorer on paper during a support hearing. Forensic experts in 2026 are trained to add back these voluntary contributions to the spouse's income for the purposes of calculating support payments, ensuring that the 401k is not used as a tax-advantaged shield against family obligations. We must also address the complexities of the 401k versus the 403b and the 457 plan. While they function similarly, the rules for division can vary. For instance, some governmental 457 plans are not subject to the same ERISA rules as a private sector 401k. This means the standard QDRO might not work. You might need a domestic relations order DRO that conforms to specific state or local government statutes. If your attorney uses a 401k template for a 457 plan, the plan administrator will reject it, and you could be back at square one paying for another round of legal drafting. This is especially relevant for teachers, nurses, and municipal employees who often hold these alternative retirement vehicles. But what happens when the 401k isn't just stocks and bonds? We are seeing a rise in self-directed 401ks that hold real estate, private equity, or even physical gold. Valuing these assets for a divorce is a nightmare. You can't just look up the closing price on Yahoo Finance. You need appraisals, liquidity discounts, and a clear understanding of how to transfer a fractional interest in a piece of property held within a retirement wrapper. This is where the 401k divorce moves from a math problem to a high-stakes negotiation. As we wrap up this section on forensic discovery and valuation traps, the picture is becoming clear. The 401k is not a simple savings account. It is a complex legal entity with its own set of federal and state masters. But even if you find all the money and value it correctly, there is one more hurdle that can ruin your financial future. What happens if the person who owns the account dies before the QDRO is processed? Or what if they get remarried the day after the divorce is final? The surviving spouse rules under federal law are incredibly strict and can override your divorce decree entirely. In the next part, we are going to explore the death of a QDRO and how a new marriage can accidentally strip you of your court-ordered retirement share. We will also dive into the anti-alienation provisions that make these accounts so hard to touch, and how you can ensure your claim remains ironclad. Imagine if you are sitting at your kitchen table in late 2026, clutching a final divorce decree that clearly states you are entitled to $450,000 from your former spouse's 401k. You feel a sense of relief, believing the hard part is over. But then tragedy strikes. Your ex-spouse passes away in a car accident before the QDRO is officially qualified by the plan administrator. You might assume the divorce decree protects you, but under federal ERISA law, you could be in for a devastating awakening. In many historical trends and legal case studies, if the participant dies before the QDRO is deemed qualified, the plan may revert to the named beneficiary on file. If that beneficiary was never updated, or if federal law mandates the current legal spouse takes precedence, your $450,000 claim could vanish into a legal void. This is what experts call the death of a QDRO, and it is the ultimate nightmare scenario in contemporary American retirement division. To prevent this, savvy legal teams in 2026 use what is known as a nunc pro tunc order, a Latin term meaning now for then. This is a retroactive court order that attempts to backdate the effectiveness of a QDRO to a time before the participant's death. However, plan administrators are not always required to honor these, and many federal courts have split on their validity. This highlights the absolute urgency of moving from a divorce decree to a qualified QDRO in days, not months. Waiting for the administrative process to play out without protective language in your initial filing is like leaving a vault door open in a crowded city. You must ensure that your initial settlement agreement includes a provision designating you as the surviving spouse for the purposes of that specific account until the QDRO is fully executed. Without that specific designation, the anti-alienation provisions of ERISA, which are designed to protect retirement funds from outside creditors, can ironically be used to block your legitimate claim as an ex-spouse. The anti-alienation rule is a cornerstone of American retirement law. It states that 401k benefits cannot be assigned, alienated, or attached by creditors. The only primary exception to this ironclad rule is a qualified domestic relations order. This makes the 401k a unique type of property. You cannot simply lien a 401k like you can a house or a car. Because of this, the person whose name is on the account holds a massive amount of leverage. If they choose to be difficult, they can delay the QDRO process by submitting incomplete paperwork or challenging the plan administrator's interpretation of the order. In 2026, we see more high-conflict divorces where the participant spouse uses the administrative friction of the 401k plan as a weapon of exhaustion. They know that every month the QDRO is delayed is another month they keep the full balance working for them in the market, while the ex-spouse is left waiting in financial limbo. Let us look at a case study involving a character named Robert, a senior executive in the pharmaceutical industry based in New Jersey. Robert's 401k was valued at $1.2 million. His ex-wife, Elena, was awarded 50% of the marital portion. Robert, feeling bitter about the alimony settlement, purposefully delayed signing the necessary plan documents for the QDRO. During this 6-month delay, Robert remarried. Under ERISA, a new spouse automatically acquires certain rights to a 401k plan. When the QDRO was finally submitted, the plan administrator flagged a conflict between the court-ordered award to Elena and the federal survivor rights of Robert's new wife. This created a multi-year federal litigation case that cost both parties over $100,000 in additional legal fees. The lesson here is that in contemporary American culture, the speed of execution is just as important as the fairness of the deal. If there is a gap between the end of a marriage and the qualification of the QDRO, a new marriage can create a secondary layer of legal claims that are notoriously difficult to untangle. Another critical factor to consider is the role of the plan administrator. In 2026, most major American employers do not handle QDROs in-house. They use large financial institutions or specialized third-party compliance firms. These administrators do not care about your divorce decree. They do not care if your ex-spouse was unfaithful, or if the split was amicable. They only care if the QDRO meets the strict criteria of their specific plan document. If the plan says it only allows for percentage-based splits and your QDRO asks for a specific dollar amount, they will reject it. If the plan does not allow for a separate interest for the alternate payee until the participant reaches retirement age, but your QDRO demands an immediate payout, they will reject it. Every plan is a kingdom with its own set of laws. This is why the first step in any 401k division must be to request the procedures for QDROs directly from the plan. These procedures are the roadmap. If you try to drive without them, you will almost certainly hit a dead end. Step by step, you must also navigate the issue of outstanding 401k loans during this phase. Imagine if Robert had a $50,000 loan against his $1.2 million account. When the account is divided, the plan administrator has to decide how to treat that loan. Is it a marital debt? Is it a distribution that has already been taken? If the QDRO is silent on the loan, the administrator will likely divide the net balance, effectively making the ex-spouse pay for half of the loan they might never have seen the benefit of. In 2026, the complexity increases if the participant spouse leaves their job or is laid off while a QDRO is pending. In most 401k plans, leaving a job triggers an immediate requirement to pay back any outstanding loans. If the loan is not paid back, it is treated as a taxable distribution. This can trigger a massive tax bill that suddenly lowers the total value of the account, just as the QDRO is being processed. We also need to discuss the specific challenges of the 2026 labor market, where many workers have both a traditional 401k and a Roth 401k within the same employer plan. These are two different tax buckets. A traditional 401k is pre-tax, meaning you owe the IRS later. A Roth 401k is post-tax, meaning you already paid the IRS. If a divorce decree simply says 50% of the 401k, does that mean 50% of each bucket? If the participant spouse keeps the Roth side and gives the ex-spouse the traditional side, the participant spouse is walking away with significantly more purchasing power. Historical trends show that many general practice divorce attorneys fail to make this distinction, leading to settlements that look equal on the surface but are fundamentally skewed once taxes are factored in. Furthermore, we are seeing a rise in something called a 401k shadow account. This happens when a company offers a non-qualified deferred compensation plan for high-earning executives. These plans look and feel like a 401k, but they are not governed by ERISA. They are governed by contract law in Section 409A of the Tax Code. A QDRO cannot be used to divide a non-qualified plan. Instead, you need a completely different type of legal instrument, and the tax consequences are handled differently. If you approach a 409A plan with a 401k mindset, you will find yourself in a situation where the company refuses to honor the order, and you have no federal protection to fall back on. The complexity of these accounts is exactly why they are the last thing settled in most American divorces, yet they are the most important for long-term survival. As we have seen, a 401k is not just a pile of money. It is a collection of rights, obligations, and potential tax disasters. If you do not secure your share with an ironclad, plan-approved QDRO immediately, you are leaving your future up to chance, the market, and the health of your ex-spouse. But what if the money is already gone? What if your spouse, sensing a divorce was imminent, liquidated the account or changed the investments to high-risk assets that wiped out the value? In the next part, we are going to dive into the world of dissipation of assets. We will look at how the courts handle spouses who intentionally sabotage their 401k to avoid sharing it, and the forensic ways to claw that value back. We will also look at the impact of market timing, and why the date you choose for valuation could be the most expensive decision of your life. The game of 401k division is won and lost in the fine print, and we are just getting to the most controversial part of the manual. Imagine if you wake up on a Tuesday morning in July 2026, check your joint retirement portal, and realize that $200,000 has simply vanished. Your spouse, perhaps driven by panic or a misguided sense of entitlement, has executed a massive reallocation of funds into high-risk, leveraged derivatives or has taken an unauthorized distribution. In contemporary American culture, this is known as the dissipation of marital assets, and it is the financial equivalent of scorched earth warfare. When a marriage begins to fracture, the temptation to sabotage the 401k is a documented phenomenon in historical trends. However, the legal system has developed sophisticated methods to address this. If a spouse intentionally wastes or hides retirement funds to keep them out of the divorce settlement, the court can use a process called a credit back. This means the court treats the wasted money as if it still exists and awards it to the guilty party as part of their share, effectively replenishing the innocent spouse's side with other available assets like house equity or cash savings. Let us look at a detailed case study involving a character named Marcus, a senior marketing director in Austin, Texas. In early 2026, Marcus realized his marriage to Sophia was over. Fearing that Sophia would take half of his $650,000 401k, Marcus changed his investment election from a stable target date fund to a highly speculative series of options trades within a self-directed brokerage window provided by his employer. Within 3 months, the account value plummeted to $300,000. During the divorce proceedings, Sophia's legal team filed a motion for a waste claim. They argued that Marcus's sudden shift in investment strategy, which deviated from 15 years of conservative growth, was a deliberate attempt to dissipate the marital estate. The court agreed, citing that the timing and risk level were inconsistent with sound retirement planning. As a result, the judge valued the 401k at its pre-crash level of $650,000 for the purpose of the split. Marcus was left with the actual $300,000 remaining in the account, while Sophia was awarded $325,000 from the sale of their marital home to make her whole. Marcus essentially paid a $350,000 penalty for his attempt to hide the money in a market crash. This brings us to the pivotal importance of the valuation date. In the United States, there is no single federal rule for when a 401k should be valued during a divorce. Every state and sometimes every judge has a different preference. Some use the date of physical separation, some use the date the divorce petition was filed, and others use the date of the final trial or the date the QDRO is executed. In a volatile 2026 market, the gap between these dates can be massive. Imagine if you are divorcing in a year where the market grows by 15%. If the valuation date is set at the time of filing, but the divorce takes 18 months to finalize, the account owner might keep 100% of that 15% growth, even though marital funds were technically still in the account. Conversely, if the market crashes, the spouse receiving the payout wants the valuation date to be as late as possible to ensure they are not being handed a bag of devalued assets. Step by step, the way to navigate this is through a detailed forensic look at the account statements. You must look for the line items labeled as gains and losses. A common mistake in contemporary American divorces is agreeing to a fixed dollar amount without accounting for market movement. For example, if Sophia was awarded $325,000 from Marcus's account, but the market dropped by 10% before the transfer was completed, Marcus would have to liquidate a much larger percentage of his remaining shares to cover that fixed dollar amount. To avoid this, modern settlement agreements often use language that awards a percentage of the account, adjusted for investment earnings and losses from the date of the agreement until the date of distribution. This ensures that both parties share the market risk and the market rewards equally during the administrative waiting period. Another layer of complexity in 2026 involves the dividends and interest. Many 401k plans automatically reinvest dividends. If your QDRO is not specific about whether the alternate payee is entitled to the reinvested dividends accrued during the pendency of the divorce, those funds could stay with the participant's spouse. Over a year-long divorce process on $1 million account, dividends can total tens of thousands of dollars. This is not fluff. This is real purchasing power that is often left on the table because of sloppy drafting. In historical trends, the spouses who come out ahead are the ones who treat the 401k as a living, breathing entity rather than a static number on a page. We also need to discuss the concept of the temporary restraining order on assets. In many U.S. jurisdictions, the moment a divorce is filed, an automatic temporary restraining order (ATRO) goes into effect. This legally prevents either spouse from changing beneficiaries, taking loans, or moving money within a 401k. However, the ATRO is often ignored or misunderstood. If Marcus had ignored the ATRO and moved his money into those speculative options in 2026, he could have been held in contempt of court. This is why the first step for any spouse entering a divorce should be to serve the 401k plan administrator with a notice of the pending divorce. While a plan administrator won't always freeze an account based on a letter, it puts the institution on notice and creates a paper trail that can be used to prove intentional misconduct later. Now, consider the role of the employer match and the vesting cliff. In contemporary American culture, job hopping is the norm. Many people in 2026 are working for companies that offer a 401k match that doesn't vest for 3 to 5 years. If a couple is divorcing in year 4 of that job, a large portion of the 401k balance is technically unvested. If the employee spouse is fired or quits, that money is reclaimed by the company. In high-stakes divorces, there have been case studies where a spouse intentionally quits their job to trigger the loss of unvested matching funds, simply so the ex-spouse cannot have them. This is an extreme form of dissipation that requires a judge to potentially look at the spouse's earning capacity and the loss of marital property when determining alimony or the final distribution of other assets. Furthermore, we must address the issue of post-separation contributions. If Michael and Sarah separate in January but don't finalize their divorce until December, Michael will likely continue to contribute to his 401k from his paycheck. In most states, these post-separation contributions are considered separate property because they were earned after the economic community of the marriage ended. However, if these contributions are mixed into the same account as the marital funds, and they grow due to market movement, it becomes a mathematical nightmare to separate the marital growth from the separate growth. In 2026, specialized software is used by forensic accountants to perform a separate property tracing analysis. This ensures that the person who worked hard to save during the divorce process isn't forced to give away half of the new money to their ex. But what happens if the 401k is actually a solo 401k? With the rise of the 1099 economy and small business ownership in the U.S., many people are managing their own retirement plans. In a solo 401k, the participant is also the plan administrator. This creates a dangerous lack of oversight. A spouse with a solo 401k can theoretically write themselves a check or change the plan rules without anyone to stop them. In the next part, we are going to dive into the specific dangers of the small business and solo 401k divorce. We will look at how to protect yourself when your spouse is their own boss and has the power to manipulate the retirement plan from the inside. We will also explore the intersection of 401ks and Social Security, and how the 10-year rule can make or break your retirement strategy depending on the exact date you sign your divorce papers. The clock is ticking, and in the world of 401k division, a single day can be worth a fortune. Imagine if you are a small business owner in Seattle named David, running a successful boutique consultancy in 2026. Because you are self-employed, you have utilized a solo 401k, also known as an individual 401k, to maximize your retirement savings. Unlike a traditional 401k at a massive corporation like Amazon or Microsoft, you are the employer, the employee, and the plan administrator all at once. In a divorce from your spouse, Chloe, this creates a unique and often dangerous legal vacuum. Because there is no external HR department or third-party institutional fiduciary overseeing the daily movements of the account, the potential for administrative manipulation is significantly higher. In contemporary American culture, the solo 401k is a powerhouse for wealth building. But in the hands of a litigious or defensive spouse, it becomes a black box that requires surgical precision to open. The first major hurdle with the solo 401k in 2026 is the lack of standardized QDRO procedures. While a large firm like Fidelity or Schwab might provide a template for their standard 401k products, a solo 401k is often a custom design plan document. If David wants to be difficult, he can claim that his plan does not allow for alternate payee distributions until he reaches age 59 and a half, or he can attempt to amend the plan document mid-divorce to restrict how funds are moved. However, historical trends in U.S. family courts show that judges are becoming increasingly weary of these tactics. If Chloe's legal team can prove that the plan was amended specifically to frustrate the division of marital assets, the court can pierce the corporate veil of the plan and order a direct offset from other assets. Furthermore, the solo 401k allows for significantly higher contribution limits compared to a standard employer-sponsored plan. In 2026, an individual can contribute both as an employee and as an employer, potentially stashing away upwards of $70,000 a year depending on income levels. In a divorce, this creates a massive discrepancy in the marital estate very quickly. If David and Chloe have been married for 20 years and David has been maxing out this solo 401k for the last decade, that single account could represent the majority of their liquid net worth. The valuation of this account must account for the dual nature of the contributions. Are they coming from marital income? Or are they being diverted from business profits that should have been considered part of the couple's shared cash flow? This is where forensic accounting becomes the hero of the story. Now let us transition to the 10-year rule and its relationship with Social Security, which is perhaps the most misunderstood timing mechanism in the entire American retirement landscape. Imagine if David and Chloe are approaching their 10th wedding anniversary in September 2026. They have been unhappy for years, and David wants to file for divorce in August. Chloe's attorney, if they are savvy, will tell her one thing: wait. In the United States, if a marriage lasts at least 10 years, a divorced spouse is entitled to claim Social Security benefits based on their ex-spouse's earnings record, provided they are at least 62 years old and remain unmarried. This does not take away from the original earner's benefits. It is a secondary benefit provided by the government. If Chloe settles the divorce at 9 years and 11 months, she loses that right forever. Over a lifetime of retirement, that mistake could cost her hundreds of thousands of dollars in cumulative benefits. In contemporary American culture, where Social Security is a vital safety net for the aging population, the timing of a 401k division and the final divorce decree must be synchronized with this 10-year milestone. We have seen case studies where a spouse was forced to pay higher alimony for a short period just to stay married long enough to cross that 10-year threshold, securing a lifetime of federal benefits that the 401k alone could not provide. Step by step, the integration of 401k assets in Social Security planning in 2026 requires a three-dimensional view of the retirement timeline. You must look at the 401k not just as a balance but as a bridge. If a spouse is awarded $500,000 from a 401k but is only 52 years old, they have a decade-long gap before they can access Social Security or tap into the 401k without complex maneuvers. This brings us to the specific mechanics of the Section 72 T distribution that we touched on earlier. but with a deeper focus on the 2026 tax landscape. Because of the Secure Act 2.0 and subsequent updates, the rules for how you can pull money out of a 401k during a divorce have become slightly more flexible, yet more prone to error. Imagine if Chloe needs that $500,000 to buy a new home and cover living expenses while she re-enters the workforce. Under the QDRO exception, she can take a cash distribution. However, if she takes it all at once, she might jump from the 22% tax bracket to the 37% tax bracket. In 2026, with the expiration of many previous tax cuts, the federal bite on a large 401k distribution can be devastating. A better strategy involves a partial rollover and a partial distribution. Chloe could roll $400,000 into an IRA to continue growing tax-deferred for her later years, while taking $100,000 in cash to stabilize her immediate situation. This avoids the 10% penalty and manages the tax hit more effectively. But there is a catch that most people ignore: the mandatory 20% federal tax withholding. When a 401k plan administrator issues a check directly to an alternate payee under a QDRO, they are legally required to withhold 20% for federal taxes. If Chloe needs exactly $100,000, she actually needs to request a distribution of $125,000 so that after the $25,000 withholding, she receives the amount she actually needs. If she fails to do this math, she will find herself short on her down payment, and those funds are stuck with the IRS until she files her tax return the following year. The intersection of the solo 401k and the 10-year rule highlights a broader truth about 2026 divorces. The law is not just a set of rules, it is a set of clocks. There is the clock of the market, the clock of the tax year, the clock of the vesting schedule, and the clock of the Social Security Administration. If these clocks are not in sync, the resulting friction can grind a retirement plan to a halt. In the case of David and Chloe, failing to account for the solo 401k's unique structure and the Social Security timing could lead to a settlement that is legally fair but mathematically catastrophic. We also have to consider the impact of the 401k loan within the solo 401k context. Because David is the administrator, he might have taken a loan to fund business operations during the marriage. If the loan is not paid back, it is a deemed distribution. If that happens right before the divorce, it effectively drains the marital pool. In 2026, courts are increasingly looking at these business-related retirement loans as a form of marital debt that must be shared, or if taken in bad faith, as a reason to award the other spouse a larger share of the remaining liquid assets. As we move deeper into this masterclass, we have to address the most emotional and high-stakes part of the entire process: the actual negotiation. How do you decide what to give up to keep your 401k? Is it better to keep the house or the retirement? In the next part, we are going to break down the asset trade-off analysis. We will look at the true cost of keeping a primary residence versus a tax-deferred retirement account in a high-interest rate environment. We will also explore the psychological warfare of the 401k negotiation and how to stay objective when your future is being dismantled one spreadsheet cell at a time. The real battle is just beginning, and the numbers are about to get very personal. Imagine if you are standing in the driveway of your 4-bedroom home in a quiet suburb of Denver, Colorado. It is October 2026. You are looking at the house you have spent 12 years maintaining, and then you look at your phone where your 401k balance sits at a comfortable $750,000. In a divorce settlement, your spouse offers you a choice that seems remarkably balanced. You keep the house and the $300,000 of equity inside it, and they keep the 401k. On the surface, this feels like a win. You keep your home, your stability, and your zip code. But in contemporary American culture, this is known as the asset trade-off trap, and without a deep dive into the math, you might be trading a gold mine for a liability. This part of our masterclass focuses on the cold, hard numbers behind the choice between real estate and retirement. To understand the gravity of this trade, we must look at the asset trade-off analysis. In the United States in 2026, the cost of carrying a home has shifted dramatically. While the house has emotional value, it is also an expense machine. You have property taxes, insurance premiums that have likely surged over the last 3 years, and the constant threat of maintenance. Most importantly, that $300,000 in home equity is static. It does not grow unless the local housing market appreciates. On the other hand, the $750,000 401k is a compounding engine. Even if you only receive half of that, $375,000, that money is invested in productive assets that pay dividends and grow over time. Let us look at a case study involving a character named Jennifer. a pharmaceutical sales rep who went through this exact scenario in early 2026. Jennifer fought tooth and nail to keep the family home, valued at $800,000 with $400,000 in equity. To do this, she waived her right to her husband's $500,000 401k. 1 year later, Jennifer realized her mistake. The house required a new roof costing $25,000, and the property taxes increased by 15%. Meanwhile, the stock market saw a historical trend of recovery, and that $500,000 401k grew by 12%. Jennifer had $400,000 locked in a dead asset that was costing her money every month, while her ex-spouse had $560,000 in a liquid, growing account. In the world of high-net-worth divorce, we call this being house poor and retirement destitute. Step by step, you must perform a tax-adjusted valuation before agreeing to any trade-off. Remember, $100,000 in a 401k is not the same as $100,000 in home equity. In 2026, if you sell your primary residence, the IRS allows you to exclude up to $250,000 of capital gains from your income if you are single. This means home equity is essentially tax-free cash up to that limit. However, the 401k is 100% taxable at ordinary income rates when you withdraw it in retirement. If you are in the 24% tax bracket, that $100,000 401k is actually only worth $76,000 in real-world spending power. If you trade $100,000 of tax-free home equity for $100,000 of taxable 401k, you have just handed your ex-spouse a $24,000 gift. This brings us to the psychological warfare of the 401k negotiation. In contemporary American culture, many people view their 401k as their money because it came out of their paycheck. This creates a sense of personal violation when a spouse asks for a share. In 2026, we see many account owners over-leveraging themselves to buy out their spouse's interest in the 401k. Imagine if the account owner, let's call him Thomas, decides he cannot bear to see his 401k split. He agrees to take out a massive personal loan or give up every other marital asset just to keep his $1 million balance intact. Thomas is now debt-heavy and asset-skewed. If the market takes a downturn, Thomas cannot eat his 401k balance. He has sacrificed his current liquidity for a future that is still 20 years away. Furthermore, we must address the cost of the QDRO itself. Many people fail to realize that a QDRO is not a free document. In 2026, a specialized attorney or a QDRO drafting service can charge anywhere from $1,500 to $5,000 per account. If you have 4 different 401ks from previous employers, you are looking at a significant administrative bill. In negotiations, savvy parties often argue about who pays these fees. If you are the spouse receiving the money, you want the account owner to pay the fees as a cost of dividing the marital estate. If you are the owner, you want the fees split or paid by the person receiving the windfall. This might seem like small change in the context of a $500,000 split, but these friction costs add up, especially when you factor in the time value of money. Historical trends show that the most successful divorces in 2026 are those that utilize a sandwich strategy. This involves taking a portion of the 401k for long-term growth, but also securing enough liquid cash to cover the immediate costs of a new life. If you take only the 401k, you may be forced to take an early withdrawal, triggering the very taxes and penalties we are trying to avoid. If you take only the cash, you miss out on the greatest wealth-building tool in American history: compound interest. Consider the impact of interest rates in 2026. If you keep the house and have to refinance to pay out your spouse's share of the equity, you might be trading a 3% mortgage for a 7 or 8% mortgage. This increased interest expense can drain your ability to contribute to your own 401k moving forward. In contrast, the person who walked away with the 401k share has no debt, no maintenance, and a tax-advantaged account that is growing every day. The math almost always favors the person who takes the retirement assets over the oversized family home, yet the emotional pull of the home front continues to lead people into financial traps. We also have to look at the ERISA-specific protections that make the 401k a superior asset in a post-divorce world. In the United States, 401k assets are generally protected from most creditors and lawsuits. If you keep the house and get into a car accident where you are sued for more than your insurance coverage, your house equity could be at risk. Your 401k, however, is shielded by federal law. In an increasingly litigious contemporary culture, keeping wealth in an ERISA-protected vehicle is a strategic defensive move that often goes unmentioned in the courtroom. As we move toward the final stages of the 401k divorce, we have to talk about the actual transfer of funds. This is the moment of maximum risk. If the paperwork is not handled with surgical precision, the money can be held in limbo for months, or worse, transferred in a way that triggers a massive tax event. In the next part, we are going to dive into the execution phase. We will look at how to verify the transfer, how to set up your own rollover IRA to receive the funds, and what to do if the plan administrator makes a mistake. We will also explore the often ignored world of beneficiary designations, because even after the 401k is split, one wrong signature on a legacy form can send your money to your ex-spouse's new partner 20 years from now. The paperwork is the final hurdle, and it is where the most permanent mistakes are made. Imagine if you have finally crossed the finish line of your divorce in November 2026. The judge has signed the QDRO. Your attorney has sent the certified copies to the plan administrator, and you are simply waiting for the digits to move from your ex-spouse's account into your own. You feel a sense of completion, but in contemporary American culture, the execution phase is where the most silent and expensive errors occur. This is not just a bank transfer. It is a complex legal and tax-sensitive migration of data. If you do not actively manage this stage, you are essentially leaving your financial future in the hands of a low-level clerk at a third-party processing center, who may be handling hundreds of these files a week. Step by step, the first thing you must do is establish your destination account. In the United States, once a 401k is divided via QDRO, the alternate payee, that is you, usually has two primary options. You can either leave the money in the existing employer-sponsored plan in a segregated account in your own name, or you can roll it over into a traditional IRA. In 2026, the choice between these two is a high-stakes decision. If you leave the money in the employer plan, you are restricted to their specific investment menu, which may be limited to a few high-fee mutual funds. If you move it to your own rollover IRA at a brokerage firm of your choice, you gain total control over the investment strategy. However, there is a catch. If you think you might need to access the cash before age 59 and a half, keeping it in the 401k plan might be the only way to utilize the 10% penalty exception we discussed earlier. Once those funds hit an IRA, that specific divorce-related penalty waiver typically evaporates. Let us look at a case study involving a character named Christopher, a high school principal in Phoenix. Christopher was awarded $200,000 from his ex-wife's 401k. He was 45 years old and wanted to use $50,000 of that to eliminate some high-interest debt that had accumulated during the litigation. His attorney failed to warn him about the destination trap. Christopher opened a new IRA and had the entire $200,000 rolled over into it. 2 weeks later, he withdrew the $50,000 from the IRA because the money was no longer coming directly from a 401k via a QDRO. The IRS hit him with $10,000 in federal income tax withholding plus a $5,000 early withdrawal penalty. If Christopher had taken the $50,000 distribution directly from the 401k plan as part of the QDRO execution and rolled the remaining $150,000 into his IRA, he would have saved that $5,000 and avoided a massive headache. Now, we must discuss the verification of transfer. In 2026, you cannot simply trust that the numbers are correct. You must request a final accounting from the plan administrator. This accounting should show the valuation date used, the calculation of gains and losses during the processing period, and the deduction of any administrative fees. We are seeing an increasing number of historical trends where plan administrators miscalculate the market growth. Imagine if the market grew by 8% while your QDRO was sitting on a desk for 3 months. If your order specified that you were entitled to 50% of the account plus earnings and losses, but the administrator only transferred the flat dollar amount from 3 months ago, you are being shortchanged. In a $500,000 account, that 8% growth on your half is $20,000. In contemporary American culture, where every dollar of compounding interest matters, letting $20,000 slide because you did not check the math is a catastrophic oversight. This leads us to the most dangerous document in the entire retirement ecosystem, the beneficiary designation form. This is the paper that overrides your will, your trust, and even your divorce decree in many jurisdictions. In the United States, 401k plans are governed by federal ERISA law, which often preempts state laws. Even if your divorce decree says your ex-spouse has no further right to your retirement, if you die and your ex-spouse is still listed as the beneficiary on your 401k, the plan administrator is legally obligated to pay the money to them. In 2026, we are seeing a rise in legacy litigation. where children from a first marriage sue a former spouse over 401k assets that were never updated. Consider the imagine-if scenario of Sarah, who divorced her husband, Mark, in 2024. By 2026, she had built her 401k back up to $300,000. She had a new partner and a new life. However, she forgot that Mark was still the named beneficiary on her original 401k portal. Sarah passed away unexpectedly in late 2026. Despite her will stating that all her assets should go to her children, the 401k plan administrator was federally mandated to cut a check to Mark. Because of the way ERISA is structured, the court system in many states cannot reverse this once the money is paid out. Updating your beneficiary designations is the final, non-negotiable step of a 401k divorce. You must do this for the account you kept, and you must do it for the new IRA you created with the funds you received. Furthermore, we must address the issue of the lost basis. If your ex-spouse made after-tax contributions to their 401k, which is common in 2026 for those utilizing a mega backdoor Roth strategy, that money has already been taxed. If you receive a portion of those after-tax funds, you need to ensure that the plan administrator correctly identifies the cost basis. If they label the entire transfer as pre-tax, you will end up paying income tax a second time on money that was already cleared by the IRS. This requires a granular review of the 1099, our tax form that will be issued the following January. If the boxes for taxable amount not determined or total distribution are checked incorrectly, you could be looking at an IRS audit or a significant overpayment of taxes. In the 2026 economic environment, we are also seeing more people use 401k assets to fund Social Security bridging. This is a strategy where you use your 401k distributions to live on from age 62 to 67, allowing you to delay your Social Security claim and maximize your monthly benefit. If your 401k division was handled poorly, or if you took too much in immediate distributions to pay for the divorce, this bridge collapses. This highlights why the execution phase is not just about moving money. It is about protecting the structural integrity of your three-legged stool of retirement: Social Security, personal savings, and employer-sponsored plans. The execution phase also involves the physical movement of the assets. In contemporary American culture, many people expect this to happen at the speed of a Venmo transaction. In reality, it can take 60 to 90 days. During this time, the assets are often moved into a holding or clearing account, which is usually a cash equivalent fund like a money market. If the stock market rallies 10% while your $250,000 is sitting in a cash clearing account, you miss out on $25,000 of growth. Savvy individuals in 2026 now include investment direction clauses in their QDROs, instructing the administrator on how to keep the funds invested during the pendency of the transfer. Without this, you are effectively forced out of the market at a time when you can least afford it. As we conclude this part on the mechanics of the transfer and the updated beneficiary forms, the finality of the process begins to set in. You have identified the assets, valued them, negotiated the trade-offs, and moved the money. But there is one final looming question that haunts every high-net-worth divorce in America. What about the future? Your 401k is now smaller, your tax situation has changed, and your retirement age might have just shifted by 5 or 10 years. In the next part, we are going to look at rebuilding the nest egg. We will explore the catch-up phase for divorcees, the impact of alimony on 401k contribution limits, and how to use the post-divorce reset to actually build a more resilient financial future than you had during the marriage. We will also dive into the controversial world of QDRO-proofing future marriages with prenuptial agreements. The marriage might be over, but the game of wealth preservation never ends. Imagine if you are standing in your new, smaller apartment in January 2027, looking at a retirement balance that is exactly 50% of what it was 2 years ago. The legal dust has settled, the QDRO is processed, and the reality of the math has finally hit home. In contemporary American culture, this is known as the Great Reset. For many, the instinct is to panic, but for the strategically minded, this is the beginning of the rebuilding phase. To navigate this, we must look at the specific mechanics of the catch-up phase for divorcees. In the United States, the IRS provides a unique set of tools for individuals over the age of 50, but in 2026, these rules have become even more critical as the gap between middle-class savings and the cost of retirement continues to widen. The first pillar of rebuilding is maximizing your new contribution limits. If you were the primary earner and had been contributing to a family-based budget, your disposable income has likely shifted. However, you are now a household of one. Let us look at a case study involving a character named Michael, a 54-year-old mid-level manager in Atlanta. After his 401k was split, his balance dropped from $600,000 to $300,000. Michael realized that at his current trajectory, he would have to work until age 75 to maintain his lifestyle. To counter this, Michael utilized the 2026 catch-up contribution limits, which allow individuals 50 and older to contribute an additional $7,500 or more beyond the standard $23,000 limit. By aggressively funneling his former alimony payments, once those obligations expired, into his 401k, Michael was able to significantly increase his tax-deferred growth. In historical trends, those who survive a midlife 401k split are the ones who prioritize their future self over current consumption during the first 36 months post-divorce. Next, we must address the interaction between alimony and 401k contributions. In 2026, the tax treatment of alimony remains a critical factor. For divorces finalized after 2018, alimony is generally not deductible by the payer and not taxable to the recipient at the federal level. This means if you are receiving alimony, you are receiving tax-free cash. If you have earned income from a job in addition to that alimony, you should look at the feasibility of living off the alimony while maximizing your 401k contributions from your salary. This essentially allows you to convert your alimony into a tax-deferred retirement asset. Imagine if Michael's ex-spouse, Karen, received $3,000 a month in alimony. If Karen has a job earning $50,000 a year, she could technically contribute the maximum allowed by law into her 401k, using the alimony to cover her rent and groceries. This strategy effectively launders the marital settlement through a tax-advantaged vehicle, accelerating her recovery. Step by step, you must also reevaluate your investment risk profile. In a marriage, your risk tolerance is often a blend of two people's temperaments and timelines. Alone, your timeline has changed. If you are the spouse who received a 401k payout, you may now have a shorter window to retirement or a different need for liquidity. In 2026, we see a rise in the use of target date funds specifically adjusted for divorce recovery. This involves choosing a fund with a date slightly further out than your actual intended retirement to capture more aggressive growth in the early years of rebuilding, or conversely, moving to a more conservative stance to protect the seed money you fought for in court. Historical trends suggest that many people remain in the investment allocations chosen by their ex-spouse for years after the divorce, a mistake that can lead to either excessive risk or stagnant growth. Now, we must enter the controversial territory of futuro-proofing for the future. If you are entering the dating pool in 2026, you are likely doing so with a heightened sense of financial self-preservation. This brings us to the evolution of the prenuptial agreement in contemporary American culture. A standard prenup often states that what is mine, but for 401ks this is not enough. Because 401ks are governed by federal ERISA law, a prenuptial agreement, which is a state law contract, cannot always waive a spouse's right to a 401k survivor benefit. Federal law requires a spouse to sign a specific waiver after the wedding has taken place. Imagine a scenario where Michael gets remarried in late 2026 to a woman named Linda. They sign a prenup saying neither will touch the other's retirement. However, if Michael does not have Linda sign the official ERISA-compliant waiver through his HR department the day after the wedding, the prenup might be unenforceable regarding the 401k. In a second divorce, Michael could find his hard-earned rebuilding funds on the chopping block all over again. In 2026, savvy individuals are using postnuptial agreements as a secondary layer of defense, ensuring that the federal waivers are signed and recorded to protect the assets they spent years clawing back. Furthermore, we must look at the use of the Roth conversion as a rebuilding tool. If your income drops significantly in the year of your divorce, perhaps due to a job change or the loss of a dual-income household, you might find yourself in a lower tax bracket. This is a prime opportunity to perform a Roth conversion on a portion of your divided 401k assets. By paying the taxes now at a lower rate, you ensure that the growth on your new nest egg is tax-free forever. Case studies from the mid-2020s show that divorcees who utilized low-income years to convert traditional assets to Roth assets often ended up with more spendable wealth in their 70s than those who simply left the money in a traditional 401k. We also have to consider the Health Savings Account, HSA, as a shadow 401k. In 2026, the HSA is the only triple tax-advantaged account in the U.S. If you are rebuilding after a divorce and your employer offers a high-deductible health plan, the The HSA should be your next stop after the 401k match. It allows for tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. In retirement, once you hit 65, it functions exactly like a 401k for non-medical expenses, but without the 10% penalty. For someone who just lost half their 401k, the HSA is a vital sidecar to accelerate wealth accumulation. The psychological shift in this phase is the move from defense to offense. During the divorce, you were defending your share. Now you are building your empire. This requires a forensic look at your own spending habits. In contemporary American culture, lifestyle creep is the enemy of the rebuilding phase. Many people try to maintain the same house, the same car, and the same vacation schedule they had when they were married, using their 401k contributions to fund the gap. This is a recipe for a poverty-stricken old age. The most successful rebuilders are those who treat their 401k contribution as a non-negotiable tax on their own income, paid first before any other bill. As we look at the data for 2026, we see that the average time to financially recover from a 401k split is approximately 7 to 10 years of disciplined saving. This means that if you are 50, you can be back to your pre-divorce levels by 60, provided you use the tools available. But there is one final piece of the puzzle. What if the system itself changes? What if the laws governing QDROs or 401k tax treatments are altered by a new Congress? In the final part of this masterclass, we are going to look at the future of retirement and divorce in America. We will explore upcoming legislative changes that could impact how your assets are protected or taxed. We will also look at the final checklist to ensure your 401k is truly yours forever. We are going to tie all 10 parts together into a coherent strategy for survival and prosperity. The road has been long, and the stakes are high, but the finish line is finally in sight. In the next part, we close the loop on your financial freedom. Imagine if you are standing at the threshold of a new decade. It is now 2030, and you are looking back at the decisions you made in 2026. The 401k you fought for, the QDRO you meticulously drafted, and the tax strategies you implemented have either become the bedrock of a secure retirement or a haunting reminder of a missed opportunity. In contemporary American culture, the landscape of retirement is shifting beneath our feet. Legislative updates, such as the full implementation of the Secure Act 2.0 and potential new tax brackets, mean that the strategy you use to finalize your 401k division today must be future-proofed against the political and economic shifts of tomorrow. This final part of our masterclass is about the endgame, protecting your assets from future legislative reach and ensuring that the financial freedom you have reclaimed remains permanent. Let us look at a comprehensive case study involving a character named Robert, a tech consultant in San Francisco. In 2026, Robert finalized his divorce and successfully split his $1.2 million 401k. However, Robert recognized that the United States tax code is not static. Historical trends show that tax rates often fluctuate based on federal deficit levels and shifting political priorities. Robert chose to diversify his retirement tax buckets. Instead of keeping all his awarded funds in a traditional pre-tax IRA, he strategically utilized low-income years post-divorce to perform partial Roth conversions. By 2030, when tax rates for high earners saw a marginal increase, Robert was insulated. Half of his wealth was now in a tax-free Roth vehicle, while the other half remained in a traditional account. This is the level of sophisticated planning required in the modern era. It is not just about having the money, it is about controlling how much of that money you actually get to keep when you finally stop working. Step by step, the first item on your final checklist must be the audit of the qualified status. Just because a plan administrator accepted your QDRO in 2026 does not mean your work is done. You must obtain a written confirmation, often called a benefit statement or a participation certificate, showing that the funds have been officially segregated into an account under your Social Security number. In contemporary American culture, companies are merged, acquired, and liquidated at an incredible pace. If your ex-spouse's company is bought by a private equity firm in 2027, and the retirement plan is terminated or rolled into a new entity, having that physical proof of your independent claim is your only shield. Without it, your assets could be swallowed up in an administrative merger, leaving you to chase a paper trail through a labyrinth of corporate lawyers. The second pillar of the endgame is the long-term care and insurance integration. Many people forget that in 2026, the 401k is often the primary source of funding for future healthcare costs. If you are now a single individual, you no longer have a spouse to act as a primary caregiver. This changes your actuarial risk. Historical trends indicate that single retirees often face higher out-of-pocket costs for assisted living and home health care. Part of your 401k strategy must involve looking at the feasibility of long-term care insurance or hybrid life insurance policies that allow you to leverage your retirement assets. If you do not plan for the decumulation phase with the same intensity that you planned for the division phase, a single major medical event in your late 70s could liquidate the very 401k you spent years protecting in court. Now we must address the potential for post-divorce litigation. Even with a finalized decree, contemporary American law allows for certain omitted asset claims. Imagine if, in 2028, your ex-spouse discovers a secondary 401k from a job you held in the early 2000s that was never disclosed. In many states, they can reopen the property division portion of your divorce to claim their share of that newly discovered marital asset. This is why the full and final disclosure clause in your 2026 agreement must be ironclad, including a mutual release that prevents future fishing expeditions. You want to ensure that once the gate is closed, it stays locked. We have seen case studies where individuals were forced back into court 5 years after their divorce because of a clerical error on a decades-old plan document. Furthermore, we must look at the impact of inflation on your divided assets. In 2026, the purchasing power of $500,000 is significantly different than it was in 2016. If your 401k is sitting in a conservative cash-out fund because you are afraid of market volatility after the divorce, you are effectively losing money every single day. The safe withdrawal rate of 4%, a historical trend used by many planners, may need to be adjusted downward if inflation remains sticky. Rebuilding your 401k requires an aggressive stance on low-cost index funds to outpace the rising cost of living. In contemporary American culture, being safe with your money is often the riskiest move you can make. Consider the role of the estate plan post-401k division. Now that the account is yours, what happens to it when you are gone? In 2026, the stretch IRA rules have been largely eliminated for most non-spouse beneficiaries, meaning your children or heirs will likely have to withdraw the entire balance and pay the taxes within 10 years of your death. To mitigate this, many savvy divorcees are looking at charitable remainder trusts or using 401k distributions to fund permanent life insurance policies that provide a tax-free death benefit. You have fought a war to keep this money. Now you must decide how to leave a legacy that is not decimated by the tax man. Step by step, the final action is the annual financial physical. Every year on the anniversary of your divorce, you should sit down and review your 401k balance, your beneficiary designations, and your progress toward your new retirement goal. The person you were during the divorce was likely operating from a place of fear and survival. The person you are a year later is operating from a place of growth. Adjust your contributions, rebalance your portfolio, and stay informed on new IRS limits. In the United States, the only constant in finance is change, and your 401k is the most dynamic asset you own. In contemporary American culture, the 401k divorce is more than a legal hurdle. It is a rite of passage into a new kind of financial independence. You have moved from a joint future to a self-determined one. You have navigated the QDRO minefield, avoided the early withdrawal traps, and factored in the hidden tax liabilities. You have looked at the math of asset trade-offs and protected your interests against the death of a QDRO and the surviving spouse rules. This masterclass has given you the forensic tools to ensure that your split is not just fair, but functional for the long haul. As we conclude this 10-part deep dive, remember that knowledge is the only asset that cannot be divided in a courtroom. The strategies we have discussed, from coverture fractions to 72T distributions, are the keys to the kingdom. You are no longer flying blind. You are the pilot of your own financial destiny. While the marriage may have ended, your potential for a prosperous, dignified, and secure retirement is just beginning. The road ahead is clear, the tools are in your hands, and the future is yours to build. You have officially completed the masterclass on the 401k divorce in American culture. Now go forth and secure your legacy.